Thank you for joining over the next 20 minutes. We are going to look at one of the most consequential shifts in banking technology, Agentic AI. This is not another chatbot conversation. It is software that can reason, plan, act, and adapt with minimal human intervention. We will cover why adoption is accelerating, where the value is already emerging, and why governance has not kept pace. The goal is practical. A roadmap you can take back to your management team and risk committee this quarter, with a board-level lens on economics, control, and accountability. Start with the number that should be on every risk committee agenda this year. Grant Thornton's 2026 AI Impact Survey says only 18% of banking leaders are fully confident in their AI governance and controls. That means 82% are not. And that is more than a perception gap. It is a control gap. Agentic AI raises the stakes because these systems do not just recommend an action for a human to approve. They can take the action themselves inside core banking processes. Here is the path we will follow. First, we will define what makes Agentic AI different from the AI already in use. Then we will move to the benefits and use cases that are already creating value in banking. After that comes the hard part: why governance is lagging, and what risks autonomy adds to the register. We will close with a practical roadmap for scaling safely, so banks can move fast where controls are credible and slow down where they are not. Let us begin with the fundamentals. What separates Agentic AI from the predictive models and generative chatbots already in production is agency. Classic AI produces a score or a recommendation, and a human decides what happens next. Agentic AI interprets a goal, forms a plan, calls the tools and APIs it needs, takes action, remembers what happened, learns from the outcome, and can coordinate with other agents. That changes the operating model. We are no longer just talking about intelligence. We are talking about the authority to act inside your systems. Put the two approaches side by side, and the difference becomes clear. Traditional AI gives you a static prediction, then a human reviews it and executes the decision. That fits classic model risk management, because the model is relatively stable between validations. Agentic AI is different. It starts with goal-driven reasoning, moves through autonomous multi-step execution, and then adapts as conditions change. Humans get involved by exception. That means the old control model is not enough, because you cannot govern a system that keeps changing its own behavior with tools designed for something static. Underneath every agentic system is a simple loop. It perceives the goal, plans the steps, acts through tools and APIs, adapts as conditions change, and coordinates with other specialized agents when the job gets more complex. That is why orchestration is becoming the real differentiator. The winners will not just have the best model. They will have the guardrail layer that enforces policy, maintains auditability, and coordinates work across fragmented banking systems. In banking, that control layer is the product. The momentum is already visible. Roughly 61% of financial institutions are using or piloting AI or machine learning in production workflows, so this is operational, not experimental. Yet McKinsey's 2026 survey says only about 1/3 report mature AI governance. And on the demand side, UI finds that 70% of younger banking customers are open to an AI agent as a personal financial assistant. Put those together and the picture is clear. Adoption is strong, customer appetite is strong, but governance maturity is still lagging badly. This is not a story about a few innovators at the top end of the market. Global systemically important banks are piloting multi-agent capabilities across risk, operations, and client servicing. Large commercial and retail banks are deploying agents for lending support, portfolio insight, and fraud triage. Community banks are moving too. 70% report an AI adoption plan already underway. And fintech challengers are using agentic orchestration as a customer experience differentiator. Whatever the size of the institution, the direction of travel is the same. That brings us to the value question. The next section shifts from definition to execution, where agentic AI is already creating measurable value in banking, and which use cases are mature enough to justify serious investment. For executives, the issue is not whether this technology matters. It is how quickly value can be captured without outrunning control. That is the balance we need for the rest of the discussion. Scale what can be governed, instrument what must be observed, and avoid putting autonomous work into places the bank cannot yet defend. The reason banks are leaning in so quickly is that agentic AI touches 4 economics at once. First, operational efficiency. It can automate complex, multi-step workflows that once needed several teams and several days. Second, risk and compliance. It enables real-time monitoring, continuous fraud detection, and live regulatory tracking. Third, customer experience. It supports hyper-personalized journeys where an agent finishes the task end-to-end. And fourth, competitive edge. It opens new products like programmable deposits and embedded finance that were hard to operate before. Operational efficiency is usually the first case to get funded, because the value is easy to see. When an agent can gather data, check policy, execute the transaction, and log the result, the work moves end-to-end instead of bouncing between teams. That is what straight-through processing really means. The payoff is twofold. Routine approvals and reconciliations no longer sit in manual queues, and tasks that took days can be compressed to hours or minutes. The result is lower unit cost across back-office operations, and a much cleaner operating model. Risk and compliance is where the shift becomes most visible. From periodic review to continuous control. Instead of a batch job that flags suspicious activity once a night, agents watch transaction patterns in real time. Instead of manually mapping a new regulation to internal policy, they can draft that mapping the day the rule is published. That creates a real speed advantage in fraud and AML, but it also changes the governance model. The control is no longer something you test once a quarter. It becomes something you have to supervise continuously. For customers, the difference is simple. The agent finishes the job instead of passing it on. A request that used to bounce between 3 departments can now be resolved by one orchestrated agent working across all 3 systems. Because it carries memory and context, it can also personalize the journey in real time, not just at the start of the interaction. That means proactive value too. Flagging a fee that is about to hit, or surfacing a better rate before the customer even asks. Experience becomes both faster and more intelligent. Competitive edge is where agentic AI starts to change what a bank can actually offer. New product categories become operationally possible once agents can act autonomously within guardrails. Think about programmable deposits, where funds move automatically against pre-approved rules and triggers. Or embedded finance, delivered inside a partner platform in real time. That is not just cost reduction, it is product expansion. The banks that move early will be able to execute faster, make decisions more consistently, and open markets their competitors cannot yet serve. And that depends on governance that is strong enough to trust. The shift is already visible in 5 live use cases across banking. Fraud and AML detection are moving beyond simple rules. Loan processing is being automated from application through funding. Portfolio and liquidity management is becoming more continuous and more responsive. Compliance monitoring is turning into an always-on discipline. And complex customer service is being resolved in a single conversation. These are not theoretical bets. They are the places where agentic AI is already proving that it can lower friction, improve control, and create measurable value in production. Fraud in AML is one of the clearest early wins. Rules-based batch screening simply cannot keep pace with how fast typologies evolve. Multi-agent systems correlate transaction, device, and behavioral signals in real time, which makes the signal much sharper. They can also assemble a full investigation narrative for SER review automatically, instead of leaving an analyst to stitch it together by hand. And because the thresholds adapt as new patterns emerge, the model stays relevant. The trade-off is clear. Adaptability is powerful, but it requires ongoing model risk oversight. End-to-end loan processing follows the same logic. An agent can manage document collection, run underwriting checks, and track outstanding conditions from application through funding. Human judgment stays where it matters most, on the exceptions, the ambiguous files, and the higher-risk cases. That is why this use case matters commercially. In client work, banks are using agents to scale lending without adding headcount, so underwriters spend less time on paperwork and more time on judgment calls and portfolio strategy. It is a direct way to grow capacity without growing complexity. Portfolio and liquidity management extends what Treasury already does with algorithms today. The difference is continuous monitoring of cash, collateral, and market signals, with agents proposing or executing rebalancing within pre-approved limits. That phrase matters. Pre-approved limits. It defines where autonomy is acceptable and where it is not. The agent can flag stress as it emerges, respond faster than an end-of-day batch, and support tighter positioning across the book. But authority must be bounded before the system touches a live position. That is the line between useful automation and unacceptable risk. Compliance is one of the clearest near-term wins for agentic AI. Instead of waiting for a rule change to work its way through committees, agents can ingest new guidance as it is published, summarize it, and map it to the internal policies that need updating. That matters because it shrinks the gap between a new regulation and an updated control from weeks to days. And the direction of travel is supportive. The U.S. Treasury's 2026 Financial Sector AI Deliverable Reference Guide explicitly backs documented, governed regulatory mapping. That is exactly the kind of control banks can scale first. Complex customer service is where the experience case becomes tangible. A disputed charge, a fraud hold, and a card reissue have historically meant 3 departments and 3 explanations. An agent can connect servicing, fraud, and card systems in one conversation, keep the context intact, and surface a resolution before the customer has to escalate. That reduces friction, but it also changes expectations. EY found that 70% of younger banking customers are already open to an AI agent handling exactly this kind of task. The market is moving faster than the control model. We've now seen the promise and the use cases. The real board-level question is why governance is still so far behind. That gap is not a side issue. It is the constraint that determines whether agentic AI becomes a durable operating advantage or a fast-moving liability. So as we move into the next section, keep one idea in mind. Adoption is accelerating, but confidence in control is not keeping pace. In banking, that matters because the operating model is only as strong as the controls that sit underneath it. These numbers make the gap hard to ignore, and they come from Grant Thornton's 2026 AI Impact Survey report. Only 18% of banking leaders say they are fully confident in their AI governance and controls. Half say governance and compliance barriers are already limiting AI performance, so this is not just a risk issue, it's a growth issue. And 78% of executives say they do not have strong confidence they could pass an independent AI governance audit within 90 days. Most banks have policies on paper. Far fewer have control environments they would trust under examination. 5 patterns explain why the gap persists. First, speed over strategy. Pilots are rushed out to avoid falling behind, with governance promised later. Second, legacy frameworks do not fit autonomous agents, because model risk management was built for static models, not systems that can drift or interact in unexpected ways. Third, talent, data, and integration gaps slow planning. Fourth, regulatory uncertainty creates hesitation. Fifth, accountability is unclear when the agent acts. In too many banks, the answer to who owns the outcome is still nobody. That is why the comparison with traditional model risk management matters. Traditional MRM reviews a fixed model artifact on a periodic cadence, with a clearly assigned model owner and a validation report as evidence. Agentic AI needs something different. Continuous real-time monitoring of behavior that keeps evolving after deployment, accountability that is explicitly assigned even across multiple agents, and a live audit trail of every autonomous action. This is not a small adjustment. It is a different governance discipline layered on top of what banks already know. This is the clearest evidence that governance is buildable, not just aspirational. Among organizations still in piloting, only 7% are very confident they could pass an independent governance audit within 90 days. Among organizations with fully integrated AI, That number rises to 74%, roughly a tenfold gap. The lesson is not to wait for maturity before worrying about control. It is the opposite. Banks that build governance deliberately are the ones that reach maturity with confidence intact. Confidence is invested in, not discovered by accident. Now let's be precise about what's at stake. Autonomy and interconnectivity do not create entirely new categories of risk. They amplify the ones banks already manage. A single agent can move faster, touch more systems, and compound a small error before a human sees it. That's why the conversation shifts from experimentation to control. The issue is not whether agentic AI can create value, but whether the bank can contain it, explain it, and stop it when needed safely consistently. 5 risks deserve close attention. First, runaway or misaligned actions, where an agent pursues its goal in a way nobody intended. Second, cascading and emergent behavior, especially when multiple agents interact and produce loops or collusion-like dynamics. Third, opacity and audit gaps, where decisions are hard to explain or trace. Fourth, data exposure and cybersecurity, because broader tool and API access widens the attack surface. And fifth, regulatory and reputational risk, from fair lending issues to privacy breaches and operational disruption. In banking, each one can scale quickly. The real risk in agentic AI is not evenly distributed, and that matters for how leaders should prioritize oversight. 2 workflows stand out immediately. First, lending and underwriting, where autonomous decisions can create fair lending and consumer protection exposure very quickly if policy is not tightly encoded. Second, collections and recovery, where the controls are often thinner and the customer context is more sensitive. If governance resources are limited, this is where they should go first, because the highest value use cases are often the ones that demand the strictest control. A human review model works when the number of decisions is manageable, and every case gets real attention before anything executes. But once agentic volume scales, that model breaks in one of 2 ways. The queue becomes a bottleneck, or the review becomes a rubber stamp. The answer is not to remove people from the loop. It is to change the loop itself. Continuous behavioral governance watches the agent in real time, compares actions with policy, catches drift and anomalies early, and brings humans in by exception, where their judgment has the most value. The good news is that banking does not need to invent governance from scratch. The institution already has the core ingredients: model risk management, operational risk management, and 3 lines of defense structure. The opportunity now is to extend those controls into the agentic era, not replace them. That shift is important, because it means this is not a blank sheet exercise. It is a disciplined upgrade of the governance operating model banks already know how to run, now adapted for systems that can plan, act, and adapt on their own. The roadmap works because it phases risk and value together. Start with control before autonomy. Assign every agent a clear identity, encode policy as executable code, and turn on audit logging from day 1. Then move to controlled execution, where workflows run in bounded environments and accountability is explicit. Only after that do you scale orchestration, with end-to-end agent journeys and humans involved by exception. That phased approach, inspired by EY's framework, lets banks capture value early without waiting for a perfect governance program that never arrives. If you want momentum this quarter, there are 5 practical moves that make governance real. Build an agent registry so every production or pilot agent is cataloged and risk-tiered. Monitor for behavioral drift continuously, not just at periodic revalidation. Ensure full traceability so every autonomous action can be explained after the fact. Unify human and agent governance in one framework rather than 2. And invest in ownership and training so accountability for what each agent is authorized to do is never ambiguous. That leads to a simple self-check for any institution moving into agentic AI. Can you name every agent in production or pilot? Is each one tied to a named owner? Do you monitor behavior continuously, not just at revalidation? Could you produce a full audit trail within 24 hours? And have you briefed your regulator on the approach? If you answered no to 2 or more, you are not alone. But it also means the gap is clear, measurable, and very much fixable with a focused roadmap. Taken together, Agentic AI is a genuine paradigm shift for banking. It can reshape efficiency, risk management, customer experience, and competitive positioning at the same time. But none of those gains are automatic. They depend on proving control over systems that now act on their own. The 82% confidence gap is not a verdict. It is a warning that trust has to be engineered. In this new model, the winners will be the banks that build execution reliability, orchestration, and governance before the market forces the lesson on them. The right move this quarter is practical, not theoretical. Start by assessing governance maturity across every deployed or piloted agent, so you know where control is strong and where it is still thin. Next, prioritize foundational controls and orchestration capability before you scale further. Then align early with regulators and outside experts. In banking, that usually accelerates safe adoption. Finally, scale safely through your highest value, best governed use cases first. That sequence gives you the discipline to expand with confidence, instead of discovering the gaps after the technology is already in production. Thank you for the time and the attention. The central message is straightforward. Agentic AI will reward banks that pair ambition with disciplined control. If it helps, the next conversation can be about where your institution sits on that maturity curve, which use cases are ready now, and which risks still need to be governed before they scale. The institutions that move early, but responsibly, will shape the standard for this market. I look forward to the questions and to exploring that path together.